Welcome to Polaris-Live. This is your host, Sarwar Kashmeri. Thank you for joining us. Today's conversation in the series of programs on the U.S.-China relationship and its global impact as seen through the eyes of experts from around the world. This user-supported channel brought to you live in conjunction with the Foreign Policy Association of New York. During the program, you may ask questions using the bar on the right-hand side of the screen. Reminder, you can also listen to these programs as podcasts on your favorite platform. My guest today is Mr. George Magnus, the well-known economist from the China Center of Oxford University. He's a long-time observer of China's economy and its rapid rise over 4 decades from a relatively poor country to superpower status. George was chief economist and then senior economic advisor at UBS Investment Bank. Welcome to Polaris Live again, George. So nice to have you with us.
It's good to see you.
George, tariffs to the left of us, tariffs to the right of us. You argue that going back to the way things used to be is probably the least likely outcome, and this global trade reset was inevitable. Why? The world runs on trade.
Indeed, it does. But I think that we called it free trade. I mean, there's really never really been such a thing as genuinely free trade, because there have always been some rules and impediments. But for decades after World War II, they were kind of managed in what we believed to be a very structured and orderly way, and we were all supposed to obey the rules, etc., etc. But I think that the reason we are not good, I'm not saying ever in history, future history, but I don't think there's any chance in the foreseeable future that we can return to the status quo ante, to the way things used to be before, say, 2017. And the reason for that, in a nutshell, is global imbalances. So, obviously, as I think everybody really understands, President Trump, has been kind of obsessed, or is obsessed with bilateral trade imbalances. If we just kind of move to a parallel path to that for the moment, the world does have a problem with extreme levels of imbalances, represented by not just America's trade deficit overall on the one side, but of course China's enormous trade surplus on the other. And that imbalance is really something which is giving rise to a lot of problems, a lot of distortion, a lot of political pushback. And I think that's why, and while this kind of adversarial relationship exists in commerce, which is part of a much bigger adversarial relationship, trade, investment, commercial relations will remain under stress, under strain, and what we call global fracturing, I think, is more likely to take precedence in our world than global integration.
Question for you. The point is always made, and I think China makes it now and then, is if one also looked at the trade in services, the picture would be a little bit different. Do you agree with that?
Mathematically, that's absolutely true, and economically, it's something that's worth noting. And obviously, because America has generally a kind of big surplus in terms of service exports rather over imports, it does go some way mathematically to reducing the nature of the so-called imbalances that everybody gets very kind of worked up about. The problem is that, of course, that politically it means much more for goods in the goods world rather than in the services world. Services are rather kind of amorphous. They're difficult to measure. You can't see them necessarily. They take place, online, and they're politically much less sensitive than I think merchandise goods are, which are, generally speaking, produced by communities and by localities where industries and firms
Yes.
have prominent positions. And when they're no longer there, then of course we get all sorts of political problems which linger and fester and have a manifestation which doesn't take place on Wall Street, say.
Now, here's an early question for you from one of our viewers. There was no imbalance when US and EU were dumping cars into China, but now all of a sudden there is.
Well, I don't know about that. I mean, I think that we did have a chronic period of imbalances in the world in the 2000 and, well, in the run up to Lehman's, shall we say. So between about 2003 and 2007, 2008. And indeed, one of the reasons that I think, it's going over old ground a little bit, but one of the reasons that we ran into the great financial crisis in 2008 was rooted in imbalances which were represented in part by huge trading imbalances as well. But I think that, after Lehman's, and obviously there was a huge kind of shakeout and we went through a big recession, et cetera, et cetera. But I think it's really come back into focus, I think, since just before COVID, and especially since COVID, in particular, I would say China's goods surplus now running up to about $1 trillion, or about 5 or 6% of its GDP. This is quite unusual. I mean, even in the sort of good old days, as we say, when Japan was the sort of focal point of global imbalances in the 1980s, Japan's surplus was never anything near close to that. So this is quite exceptional, what we're seeing at the moment.
George, you titled your last book, your best-selling last book, Why Xi's China is in Jeopardy. There was a subtitle. Is China still in jeopardy 6 years later?
Yeah, I mean, I like to think that the book title was, which I wasn't quite on board with actually when the publisher suggested it originally, but I think it was quite prescient as things turned out. I mean, I'm talking to you now against a backdrop where, unless you happen to be watching China very carefully day to day, there is uncertainty, let's put it like that, about Xi Jinping's actual status and whether not that he's about to be removed, but how much power he's got, whether he's being challenged by certain individuals in and around the center of the Communist Party, whether there's problems looming, between him and senior members of the PLA. So I don't want to get into that because a lot of it is speculation, but let's just say that his status or his position within China, at least for the moment, there seems to be a bit of a question mark over it. But my kind of thesis in the book, and subsequently really, has been about the fact that the rising China, the inevitability of China's supremacy in the global economy. To me, that was always more hype than real. And I think that, if anything, and even allowing for all of the kind of distortions and problems which COVID brought, not just to China, but of course to everybody at the time, but allowing for all of those things, I think China's economy is now in worse shape than it was, say, 5 or 6 years ago.
Really?
Which is ironic in a way, because on the one hand, China has an enviable modern sector with world-class companies and products in climate change mitigation and electric vehicles and batteries and solar and wind and so on and so forth. On the other hand, it's got a hugely problematic macroeconomy, which the government seems unable or unwilling to get a grip over. So this kind of dichotomy, I think, is remarkable. And it's why I think, Xi's China is still in jeopardy.
I want to switch to the other side of this coin. Interest on US debt now exceeds its defense budget, which is almost $1 trillion. That's 1,000 billion. US creditworthiness has now been downgraded. Sounds to me that America too is in jeopardy now, is it not?
It's got some big problems, that's for sure. I mean, the two things that you mentioned there, Sarwar, I mean, are notable, but not necessarily killer factors. Let's put it like that. I think there are other things that we need to be rather more concerned about. Let's put it like this. I mean, I know that the historian Neil Ferguson has often said in recent months and last couple of years, if at least, that that great powers are in great problems, have great problems when the interest payments exceed defense spending and so on. Well, I mean, the United States isn't unique in that regard. I mean, the same applies to China. The same apply, whatever. I mean, we don't really know what China's defense spending really is, but on most estimates, its interest payments, if you look at the expanded and definition of public sector debt rather than just Beijing's debt, it's true for China, it's true for a lot of countries. Maybe it won't be true in years to come when everybody spends more money on defense. But presumably that's going to add to borrowing and interest costs too. So it is a factor. It's obviously it's a major fiscal dysfunction,
Right.
which is not common and certainly needs to be kept an eye on. But I think the fiscal dysfunction is much more prevalent when we look at the costs and the embedded and implicit liabilities of aging, which is really about pensions, residential care, healthcare expenditure, and so on. I mean, these kinds of things actually are much, much more significant. But let's call a spade a spade. The interest cost is something that is a problem, particularly because the size of the stock of debt, of course, is so high. The downgrade, I think, is not really something that I don't really pay a lot of attention to those kinds of things, because when the rating agencies downgrade the United States from AAA to AA1, which is what they did recently, I mean, it's like shutting the stable door after the horse has bolted. I mean, financial markets are well aware of the reasons of why these things happen, and they anticipate it usually very, very well in advance. So, it doesn't mean that America's going to go bust. It doesn't mean to say that, America's going to have hyperinflation. It doesn't mean to say that, America can't take care of its own liabilities, because obviously it has an independent central bank, it has a global currency, and it can print as many dollars as the Federal Reserve is allowed to print. So I don't think we should lose too much sleep over that. But it does send a message, which is something that I think everybody is conscious of, which is that under President Trump, obviously the trust in the United States and in its institutions is less, than it was 3 or 4 or 5 years ago. And it's more uncertain and more volatile. We don't really know, from 1 month or 1 week to the next, what President Trump is going to mandate in terms of commercial policy or legal policy or whatever. So this is not a good time, obviously, for trust in the US institutions. And I think it's something which we need to keep a very close eye on.
Yeah, but there was a time not long ago when people looked to the markets to signal how things were going, and some people now say don't rely on the markets for any great insight. I mean, Wall Street is optimistic. The S&P 500 has bounced back from its April trade war meltdown. It's flirting with February's record high, but other markets are telling a different story. The bond traders and currency dealers don't share the stock market's confidence. So do you think the markets are losing their allure as a signaling mechanism?
Well, as a sort of a long-time servant, in the sector, I mean, I suppose I retired from it with a certain amount of cynicism, I have to say. I think what we've seen, everybody's kind of talking about the bond market shock and what's happened to Treasury debt prices and yields. But I think what's happened in the Treasury market is that the market has normalized after the extraordinary circumstances that took place in the years following the Lehman bust. And I think that's a good thing, actually. So the problem is that even though the bond market, I think, is probably now normal in terms of its, what it's pricing and where it is, the circumstances in the larger American economy and global economy are definitely not normal. And so there is a disconnect here, I think, which we don't really know how it's going to be resolved. If abnormality in the American and global economy persist for a very much longer, I mean, into 2026 and so on, I mean, it's quite possible that the bond market is just going to give up. Either yields are going to go up a lot because there's going to be too much inflation, or they're going to come down a lot because there's going to be a recession. We don't really know which way that's going to break if it does. And the alternative is that the bond market is more or less correctly priced, and we're making having too much angst about the economy. The politics obviously are not great from the point of view of comparison with where we've come from, but from the point of view of technology in the United States, which is, we shouldn't forget that America is still, racing ahead, as the Chinese are as well, in, a dozen world significant technologies for the future. Capital expenditure is kind of on the rise. A lot of equity capital still wants to come to America to take advantage of that. So, it's a mixing bowl where, it can be half full or half empty. It depends which way you want to look at it.
Let me take a moment, George, to remind viewers that Polaris Live is a commercial-free and entirely viewer-supported channel. We'd appreciate you signing up to our mailing list at www.polarislive.com and at Kashmeri.com. There's no cost, and it really does help us. And of course, we always welcome your comments on our video and our podcast channel. George, switching a little bit about the American avowed objective of stopping China in its track by disconnecting it from the world, by not providing. And there's another slide there that I'd like for us to see. The United States is convinced its policies are going to slow down, if not block, China's growth. I want to ask you if you think that's possible. And this picture and from the Financial Times just a few days ago points out why. I mean, there was a blank sheet, there was a sheet of metal a few minutes ago, and these robots have transformed it just a few minutes into this outline of a new Audi. And the Audi CFO says that they had to go back to China because of the prices in China. No one else can offer them. I read today in the papers that Ford is thinking of moving some of its manufacturing of electronic equipment to China because the rare earths that are required for them are not available. I mean, do you think that this is wishful thinking, unrealistic wishful thinking on America's part, that it is going to block this behemoth trajectory that China's been on, especially given this objective of President Xi Jinping to master 5 or 6 key technology and become the leaders in it? Long question here, but I just wanted you to talk about that because it's headline stuff here in America.
Yeah, it's a great question, Sarwar, and we could talk about this for a week, actually, or more. So what do I think? I think I don't think it's possible for the United States to slow China's economy down. Actually, it doesn't need to do that because China's economy is slowing down all on its own. It doesn't need America's help to do that. I don't think the United States should try to sort of undermine China's economy. It would be far better off and be much more advantageous to America's competitiveness and to its ability to, sell itself in terms of PR to the rest of the world, so to speak,
Right.
By concentrating on doing what it does best, better, which is, in other words, improve. It's a sort of an inward-looking view, which is to say, be as good as you are at technology and diffusion and breaking new ground in products and processes, innovation. Just do it more, do it better, and compete that way. And I think that is kind of usually understood to be very good advice. Having said that, I don't think we can deny that we do live now in an intensely adversarial world in which there is obviously a lot of competition. Bona fide commercial competition, but also strategic competition, because so many products which are now, which used to be, we didn't used to think about national security as something that actually expanded much beyond military and intelligence matters.
Right.
But now it includes technology, it includes energy, it includes a whole range of things which actually enter into bilateral relations, data, cyber security, et cetera, et cetera. So we are in this competition, and I think just as the Chinese are trying to de-Americanize their own supply chains because they don't want dependence on the United States or United States companies, so the United States is trying to de-Sinify its own supply chains. We may approve or disapprove of whether this is a good idea, but I think that is a reality, and I think that's exactly how we should think things will continue for the foreseeable future. Whether Ford, in the case that you mentioned, or Audi, have great insight in whether they want to sort of improve or increase their investment in China. There's obviously company by company things that actually will take place. All I know is, really from looking at the data and the evidence supplied by the European Chamber of Commerce, the American Chamber of Commerce in China, is that a rising and significant share of their companies are actually looking to build their new investments outside of China. Not necessarily in the United States, although sometimes that is the case, but often in other Asian economies, or in Mexico, or in Turkey, or other places where they think that they will be free not only of sanction risk, but also of the conflict between local and Chinese laws and regulations. That is also, I think, a feature which will likely remain with us for the future. So I do think this is not a one-sided issue. I think there's a sort of a separation or a decoupling, if you want to put it that way, which I think is very difficult. That I think is quite difficult to stop.
Series of questions coming through, George, but here's one which I thought you might want to just have a shot at. This questioner says, U.S. real assets are only in chips. No?
Only in?
Chips.
Chips. I'm not sure about that. There are a whole range of technologies in from agribusiness to chemicals to, AI and, semiconductors, et cetera, et cetera. Well, at least semiconductors is design, if not fabrication. I think the United States still has a lot of advantages. It also has the biggest consumer market in the world. So, when we are going into, getting fussed, really, as we all do, by the volatility of the tariff regime and which one will prevail today and which one will prevail tomorrow, it's very easy to say, well, people will turn their back on the United States and go and trade with somebody else. There actually isn't anybody else to trade with that's as big. So there's no substitute, really. China can't offer the same opportunities for other countries to export to as the United States does. So, it has obviously frailties that I think are kind of in the public domain all the time, but it also has kind of strengths which actually and dependencies which I actually think are worth something too.
I'm going to leave some of these questions coming up for later, but I wanted to ask you, and this is a question closer to home, that the United Kingdom came to this agreement with the U.S. on tariffs and settled this issue. Do you think, I mean, there's some controversy on that, but do you think that ultimately the settlement that the UK got was good for it? Do you think it had gave up too much? Any thoughts?
It may be that, the British government was a bit hasty, given what's happened to the legal process that's going on at the moment with regard to the tariffs that the White House has proposed. And I think that there is obviously kind of an issue about, obviously product tariffs, like steel tariffs, for example, are outside of the court's remit. This was really only about other more general and reciprocal tariffs. So it's possible that the British government jumped the gun a bit. But the details of the trade agreement obviously still have to be hammered out.
Right.
What they reached was a sort of agreement in principle about themes and fundamental principles. But I don't think trade agreements take a long time to draw up and sign. So it's okay. I think that for Britain, our geography here is really all about Europe, obviously.
Yes.
And we need to basically repair our commercial relations with Europe over and above anywhere else in the world, in my view. America is the biggest single trading partner that we have, not as big as the EU, of course, but therefore it is important to a lot of British companies. But I don't think, the government's growth agenda and people are going to get wealthier on the back of this trade agreement necessarily.
That's a whole area about how the EU fits into this, which I'm reluctant to open right now because we are running into the tail end of this program with you. But I want to ask you, George, if one believes that the relationship between the United States and China is perhaps the most consequential in the world, then what's taking place at this point is not very heartening. And how much more could the world get done, especially the developing countries, if this friction was not the case? So what I want to ask you is, if you had a couple of minutes privately with President Xi Jinping and with President Donald Trump, what might you whisper in their ear?
I think whatever I would whisper would receive an absolutely zero response. But okay, what would I say? The main problem, I think, with China is its reliance on an industrial policy mix, which is unprecedented in size and scale. By some estimates, China spends up to 4 or 5% of its GDP each year on supporting industry and picking winners in its strategic emerging industries. And this is causing huge amounts of problems with capacity, overexpansion, export dumping, and pushback, not just by foreign countries in the rich world like America and Europe, but also amongst emerging and middle income countries. So my kind of 2 pennies worth of advice to Xi Jinping would be to switch tack, downplay your industrial policy, concentrate much more on domestically homegrown policy to open up service industries and consumption and so on. My 2 pennies worth of advice to Donald Trump would be to just give up the kind of tariff ideas or the general tariff ideas altogether. There can be arguments for tariffs on particular sectors where there may be reason for poor behavior by foreign trade partners, or by, to protect the nurturing of domestic industries, which you were trying to get off the ground. I mean, there's precedents for that, of course. But the idea that general tariffs have any purpose or role which can benefit the United States, I think, is something that should be disavowed. I don't think it just holds any real water.
I knew you would have something very valuable to say, George, having known you for a little while. But, we could go on forever with you. You must promise to come back. But, George Magnus, we've alas run out of time. So I want to thank you so very much for that thought-provoking perspective from your perch. And you've observed China, its economy, the European Union's economy, the globe interaction for so many years. So thank you also to our viewers from around the world. But thank you, George, for arriving here.
Thanks a lot.
And please join us again for Polaris-Live.com as we continue to explore the most consequential relationship in the world, that between the US and China, and its impact in the world. Until then, next time, goodbye.